Okay, in this video, I wanted to go over some stuff with regard to just using your life insurance policy, or infinite banking, whatever your preference is. Being the bank, becoming your own banker, kind of situation. How you can use your life insurance policy, and I borrowed this from a friend, but I thought it was really good the way it showed it, because you're not necessarily funding your policy with a huge amount of money, but it's just not a small amount of money either. It's something that most people could see doing, and they can be funded in all different ways. Usually it's recommended anywhere from 7 to 10 years. You do the initial amount, whatever that is. So if it was $10,000, maybe you do it for 10 years. In this case, they did it a little different. They funded it with $10,000 for 5 years. And then they went and they reduced it down to the base premium of $4,000 ongoing. And the reason why they do that is because after you get to a certain point, just doing the base premium, you're depending on the insurance company, you might get paid higher on the dividends on your base premium than your PUA. I don't necessarily do that personally. I do and I don't. I do that first, and then as money comes in, I work with insurance companies personally that I can put money in as I go. Others that you maybe can't put in money as you go, or they say you can't, you can always, or what I do is, with the policies, I structure them to where you can put it in, like say for example, one particular company, you're able to do an extra 3 payments into PUA in the year. So you do it every 3 months after, 3 months after the anniversary date, and another 3 months and another 3 months. That way you're able to get more money into the paid up additions otherwise. So this is more of a video that some of the terms I'm saying may or may not, maybe I should explain those. Paid up additional insurance is just that. You're buying up more insurance and you're buying more death benefit, more cash value, and most of that, nowadays, most companies have about a 10% fee on the PUAs, but they give you more on the backside in dividends without getting too complicated. But so you're looking at about 90% of that money right away, and then the base premium will depend on how far you are into the policy as to how much it gives and how the policy is structured in general. In this case, this was looks like it's a 40/60 policy, and it can be structured based on need. I'm not advocating for one or the other. I do everything pretty much depending on what somebody wants. So, and there's other things that come into play. I mean, needs are also going to make sense, and then we run the numbers. The numbers have to make sense for that individual and what they're looking to accomplish. Anyway, we're getting way off the subject, but this comes back to more the way I look at it is debt reduction in a way, except in this case, you're actually using your policy to purchase this vehicle instead of using a bank. Now, you can use a bank to purchase the vehicle and then utilize this to eliminate the debt and bring that debt back into your policy. So with these numbers, these available cash values and whatever are always going to reflect the outstanding loan. And that's just simply because these numbers come from an illustration. So whenever you show a loan coming out of it, it's always going to adjust it from the cash value dollar for dollar. So that $4,800 will reduce it by that amount. So for example, I'm sorry, the $4,800 is the payment. But if you take out $20,000, where you're going to see a difference of $20,000 in general in the cash value, and it's also going to reflect in the death benefit. So anyway, if you look down here, they're paying $10,000 a year for 5 years, and then, like I said, it drops down. But in the meantime, they're paying an extra $400 a month as loan payoff as they go. So they borrow the $20,000, they pay for the car, they're putting $4,800 back just like they would do with the bank, right? The bank would pay the $20,000 or whatever. They're showing the money going back in. Now, mind you, the interest also plays a role. It's hard to tell that in this, for the simple fact that most insurance companies, whenever you take a loan out, they will hold on to or retain the funds for the first year's interest. But as you pay it back, as you pay this loan back, they will refund you a proportionate amount of interest based on the amount of money that you paid in. So, and it also depends on how far into the year it is, because it is prorated. But nonetheless, whenever you're talking about eliminating your debt and you are, and this is not a great example for overall debt elimination, but debt elimination, if you have, let's just say you have $500,000 and instead of taking 30 years to pay it off, you pay it off in 12. Some are faster, some are a little longer. Just depends on the size of the policy, depends on how vigilant they are about doing it and paying back the loans. Putting the payment you would put into the bank, or you would pay the bank if you would have taken out the loan from the bank, just paying yourself. So you're paying it back to the policy. So yes, there is interest, and people always worry about that, but at the end of the day, you have your money back and then you have a paid off car. So, and the money in the policy continued to grow. That's why these numbers get bigger and bigger. So they show that you borrowed $20,000 and, in year 7, you basically paid it off, and you have showing the total repaid right here that you put in $82,000 because that's what you paid in payments. The cash value grew $58,000. So you still had cash value growing over here while you were repaying your loan. So the loan is against the policy, not out of the policy. So you're not removing money from the policy in order to accomplish this. You are borrowing against the policy. And yes, the interest does go to the insurance company, just to be clear. But nonetheless, it is simplified annual interest, meaning that if you have, let's just say it was $100,000. I'm just trying to give easy numbers. Or let's just say it's $10,000. At $10,000, if it was 5% interest, for example, it would be $500. So that $500 now gets split up over 365 days. So it's not the same as a normal car loan, or even or even more so a mortgage. A mortgage, they front load the interest with the first 5 to 8 years. But nonetheless, in this case, they're buying a new car periodically, and they're buying a $20,000 car. So it's not a super expensive car, but this is just for the sake of an example and keeping the money moving. Okay. It is not to show, the big bang of what you would have if it was a larger policy, and you would have more growth in a larger policy, and you can have different structures and different things. But the idea is that the cash value is ever increasing. It helps offset any interest that you're paying, and you continue to build this nest egg within this policy ongoing. And like I said, if you were to do this for overall debt elimination, it helps because the cash value continues to grow. Every time you pay new premium, you're getting dividends and interest. So you're making those dividends off of the new premium. So there's going to be additional money coming to you for making your premium payment. And especially once you start getting, after year 5, you essentially get your money back and some. A regular illustration would show that better, but you start getting something extra above and beyond what you paid in, and then so on and so forth. And in some cases, you're paying in here somewhere around year 10 to 12, and you're more than doubling your money with some insurance companies. Just depends on the insurance company and how the policy is structured and a number of other things. But you're looking at, let's just say you were paying $4,000. Well, maybe you had $9,000 available to you after you paid it in year 11 or 12, or maybe even 10. Like I said, it just depends on the policy structure, depends on the insurance company, their cost of insurance, and different things. Without getting too far into the weeds, the concept itself is about controlling your money. And you're controlling the money. You're not dealing with banks. It's more of a concept. It's more of a concept, and it's more of a situation that you're looking at more safety of your money, because insurance policies are guarded from a lot of things in a lot of states. So, if you have money in there, it's not, creditors, whatever, IRS, divorce, all kinds of different things you're protected from. So it helps preserve your wealth with that regard. So there's a lot of reasons to use it for debt reduction. People don't know that you can use it for these things. People don't. It's a little bit hard for, also if they do know it, to wrap their head around it. But it's an amazing concept. I've been doing it for 14 years personally, and it's, been a blessing, honestly. I, have run different businesses over the years, and it has helped me grow businesses. It's helped me during, ups and downs in the businesses, I guess I should say downs in the businesses, because any business is always going to have an ebb and a flow to it. And whenever you're at those low points, maybe it's a time of year, there could be multiple reasons as to why, but the money, it's nice to have the money there to loan to my business, to constantly be able to grow. I personally try to put as much of my income into this first, into policies first, because it grows. And right now, many of my policies are more than doubling, maybe a little over double the money whenever I put it in there. So why wouldn't I put as much as I could in there? At least that's allowable. That was already preset. But like this policy right here, I can tell you that even though they're paying $4,000, which is the base premium, in most cases, most insurance companies will let you pay another $4,000 into paid up additional insurance. If you want to maximize your policy, you can do that. And you put that extra $4,000 in there, and you keep doing that for another number of years, it will change these numbers dramatically. Should I say dramatically? Maybe that's not the right word, but it'll definitely, there'll be an increase. And it just also depends on the insurance company there again. Not all of them are created the same. It has to be a mutual company that pays, dividends. And it can't just be the guaranteed amount. It has to pay dividends above and beyond the guaranteed amount or percentage that they're supposed to pay you. And the flip side is that does follow Moody's corporate bond index, which has been at an all-time low. And even though some of these insurance companies have still maintained a good interest rate and or basically a good dividend rate, I shouldn't say interest rate, dividend rate. And and with all this inflation that's going on, eventually we will see some sort of increase on the insurance side as the dividend rate goes up. So anyway, I hope this kind of gives you, like I say, it's just an example. Some people say it's not the best use of your dollars, like you should borrow against it and do like you would do with say your primary residence. Your primary residence, you take that money and you refinance your house, you do a cash out, and you go and you buy a rental, another rental home to get the cash flow from that. Of course, you have a loan, you're paying interest, all of that good stuff. That's nothing new. This is the same kind of idea if you were going to go that route. Is you have your policy, you borrow against your policy if you have enough cash value, excuse me, and you take that and you do the same thing. You can do a rental property, or you can put it into the market. Whatever you do, whatever you invest in, you're making your money work twice as hard because it's still growing in the policy. As long as you're putting the money back at some point, or at least paying the interest, you're gonna get the benefit from it. You pay the interest every year. There's a lot of different ways to do this. For the most part, making the payments back to your policy makes the most sense. Because all you're doing from a debt elimination side of things, you're taking over the debt. So let's just say you start from small debt to large debt, like a normal debt snowball, and you do your highest interest rate, which is usually your smallest credit cards, and say that's $1,000. You pay that $1,000 worth that $100 a month or whatever it was that you were supposed to be paying minimum payment. At the very least, or maybe you paid more than a minimum payment, should be going back into your policy. And then the next time you have a chunk of money, or maybe you had more money that you paid off other debt, other credit cards, for example, you take that and you roll it into the overall amount that you're paying back to the policy. And that's going to accumulate again. And at the same time, at some point, in 12 months, you're going to pay another premium. This is all your normal debt that's on what you'd be paying every single month. So when people look at this, they're like, how am I going to do that? Well, you're already doing it. All you're doing is making the dollars that you put into the life insurance policy work again in a different way. They're saving you interest and they're helping you eliminate your debt. And some people are like, well, that's not the best use of the money. Well, I mean, it all depends on the individual. Some people don't like to be in debt, and they just don't. And so they get rid of their debt. There's nothing wrong with that. And once they get rid of their debt, if they want to, then they go onto the cash flowing assets. But yes, there are some people like, well, I want the cash flowing assets now, and I want the income from the cash flowing assets now to pay off my debt. Okay, great. That's a good strategy too. It's all preference. And I'm not advocating one or the other, because I have clients that do both. Maybe they only use it for debt, or maybe they only use it for income, cash flowing assets, or maybe they do both. It's all up to the individual. Anyway, please like, subscribe, hit the notification bell. I hope this helps. I tried not to make it confusing, but if it was, please let me know in the comments. I'll try to streamline it a little bit. I got off on some rabbit trails just because there's so much to talk about, and there's so many different ways you can utilize these things, and I just get to thinking about it and it just kind of comes out. Anyway, have a good one.